One of the most powerful elements of a whole life insurance policy is the ability to leverage the cash value for investment opportunities, for an emergency fund, for collateralized opportunities for a lot of different ways. One of the ways that people have really taken advantage of this over the past couple of years is through what's called an insurance-backed line of credit or cash value line of credit through third-party banks. It works very similar to like a home equity line of credit on the equity of your home. It utilizes the cash value as collateral to guarantee the line of credit. Now, does it make sense anymore? A year and a half ago, insurance-backed line of credits were all the rage because you could do all sorts of really cool things with them and create a lot of flexibility, create positive arbitrage on a guaranteed basis for a period of time. So the question is, now that rates are going up, now that the environment has changed with banks and with insurance companies, what do insurance-backed line of credits look like today? It's what we're gonna get into. So if you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Let's get into it. Hey, what's going on, Cashflow hackers? It's Chris, Life 180, and today we are going through the insurance-backed line of credits versus the policy loan provisions inside of a whole life insurance policy. If you have a whole life insurance policy, or if you are looking to get a whole life insurance policy and you're looking to leverage the cash value in the life insurance policy, does it make sense to use a third-party bank to get a line of credit and collateralize that whole life insurance policy, or does it make sense just to use the cash value inside, or the policy loan provision inside of the whole life policy in general? And so what I'm gonna do now is I'm gonna pull up my screen. I'm gonna share this. I wanna just kind of write this out and talk about it. So there's some things here that I think are really important to contemplate and to understand. So first off, when we talk about an IBLOC, so an insurance-backed line of credit is what that stands for. It can also be a cash value, CVLOC, cash value line of credit. That's another acronym for what we're talking about here. But at the end of the day, these are both just ways to compare using and leveraging the cash value in the policy, utilizing that cash value as collateral to get a line of credit associated with it. Now, here's what happened. A couple of years ago, you could get a cash value line of credit, and the rate, I was talking to people that were getting 2.25% cash value line of credit, right, on their policy. So if you had, think about it, if you had, and this is just what was happening, I want to go through kind of what was happening a couple of years ago. What was happening is people had, let's just say, a couple $100,000, $200,000 of cash value in their whole life policy. So whole life net cash value, all right, NCV, net cash value of a whole life policy. They'd be able to collateralize this $200,000 because the policy loan provision inside the policy would say, oh, we're gonna charge you 5%, right? And so that didn't make sense when you could go to a bank and get this 2.25%, right? Because think about it, it's just baked in arbitrage. If you could, instead of paying 5%, you could pay 2.5%, but you're earning, let's say, a 5% dividend. Now that spread, you're able to bake in this arbitrage. Even on a net basis, you could be making money on the money you're leveraging for assets like real estate, and it was just an amplifier on top of everything. Now, here's the cool part, and I think this is one of the reasons I love whole life insurance so much, is because of the flexibility and because of the fact that when you buy into a participating mutually held company, you are partnering with the insurance company and you are using them to kind of manage your risk and the purchasing power of your cash value, of your savings. So from a long-term perspective, you're gonna earn enough money that's gonna kind of be a hedge against inflation. It's gonna be better than a bank account return long-term as far as the internal rate of return of that policy. You're gonna get all the additional benefits like life insurance, like living benefits, if you become terminally or chronically ill in retirement, or anytime, quite frankly, you have access to the death benefit while you're alive, and that's great. And you can leverage this cash value kind of like you could with a whole life insurance or with a bank account. You have access and liquidity of that money the same way. Anyway, that's the thing. So here's the deal. So let's just say this is 2021, right? Now we're in 2023. And the challenge is that 2.25% has now gone to about 8.5%, maybe 8.5 to 9%. Because here's the deal. What they do is these cash value lines of credit, typically what they're doing is they're charging a prime plus rate. And usually the prime plus is like a 0.5% on top of prime. And right now, prime is 8.25%. And so depending on the value of your cash value line of credit, a lot of people have seen this number creep up from 2.25 to 8.5 to 9%. And that is actually completely catastrophic to people. Now, the good news is if you have a cash value line of credit, what I would really encourage is to refinance that debt and utilize a policy loan provision, because chances are you're paying a higher percentage now. You're paying in the 8.5 to 9% range when initially you were paying that 2.25%, when now you can refinance into the 5% range through the whole life insurance policy loan. Maybe it's 5.5, maybe it's 5 3/4, depending on the company you're with. But at the end of the day, it's still better than what you're getting with a cash value line of credit. And the cool part is with the whole life insurance policy is that right now, like, if you look at it back in 2021, a lot of people were looking at this 5% rate and they were like, why would I ever pay 5%? I could go get a mortgage for 3.5%, 3%, 2.85%. I can get a cash value line of credit for 2.25%. Why would I ever want to pay 5%? And it's so funny that the principles of this stuff never change, and the flexibility of a whole life policy, because of the guarantees of the cash value, banks are always looking to lend against those guarantees. And because of the fact that you have the guarantees as far as the loan provision, I don't know if you know this or not, but whole life insurance policies have an 8% cap on the loan rate. So now that interest rates are going up, and now you look at the prime rates going up to 8.5%, you look at mortgage rates, especially on investment properties, going up to the 7.5 to the 8% range. Now all of a sudden, having access to $200,000, $300,000, $400,000 inside of a cash value policy where you can borrow against that and leverage it at 5%, now that money and that loan rate is way more powerful and has a lot more strength than it ever had before. And so what I would say right now, and this is the beauty of whole life insurance, once again, right now, I would say it makes sense to not use an insurance-backed line of credit. Why? Because the insurance-backed line of credit rates are way too high. They just don't make sense right now. It makes sense with the insurance-backed line of credit as the market kind of goes back and forth when rates are low with banks, and we don't know what's going to happen. I mean, I listen to a lot of economists. I listen to a lot of people that have a lot of really strong opinions on both sides of the pendulum, right? Some people believe that interest rates have to go down, that the economy, strength of the economy, the confidence of the consumers is all based on the fact that people believe rates are going to go back down. And if that happens, that will obviously stimulate things. And if that happens, that'll obviously make things go back more to the cash value line of credit realm. But if rates keep going up, remember, rates in the early 80s went up to like 19, 20%. All the while right now, if that happened again, I don't think it's going to get there, but if it happened again, even if rates got to 10, 11%, if that happens, your cash value loans on the policy loan provision in your whole life insurance policy cannot go higher than 8%. It's going to follow the Moody's bond index, but it cannot go above 8%. And when you look at it from that perspective, that's an extremely powerful tool. And from, if you look at this and you have that money now, there's different ways to look at this, because remember, when you look at these numbers and you look at the prime rate and you look at what's going on with the federal funds rate, that drives the entire economy, right? So whether you're looking to do private money, doing fix and flips for houses, doing hard money, you're looking to borrow money for your own investments, any of that nature, whatever side of that equation that you're on, if you have access to capital and that money is sitting inside of a whole life insurance policy, you are in control and you can leverage that to whatever capacity that you want. So think about it this way. Here's the deal. If you have, let's say, a couple $100,000 and the market has gone up, and let's say the typical rate is 10% for a mortgage, and I don't think we're that far off from that right now. We're 7.5 to 8% right now, and things keep kind of trending in that direction. So if you are in that position, right, and if rates are that high, and you know that the most you're going to pay is 8%, you can utilize your policy as a private money lender to get it out there to people. And now, right now, just hypothetically speaking, right now with rates at 8%, the typical hard money loan is between 14 and 16%. So if they go to 10, let's say the hard money cost of money goes to 18 to 20%. If you know that your cost is only 8% and you're able to give it to people at 20%, you can bake in pretty much a guaranteed or very well collateralized loan for hard money and basically bake in a 12% return, right? Now, going back to this, the point, I mean, that's not the point of this video, but that's just kind of like a benefit of leveraging the cash value inside of the whole life insurance policy and using the policy loan provision. Now, as time goes, I guess what I would encourage you to think about is if you've had a cash value line of credit and if you've utilized that, I would really look at refinancing that, cashing out, paying back the policy, using the policy cash value and using the policy loan provision to pay off that cash value line of credit, close it out, go back, have all the money inside of the whole life insurance policy loan provision, reduce your cost of money in that situation. And then what you're gonna do is you're just gonna ride that out until rates go down, keep your credit good, make sure you're a person that will qualify for them. If rates come back down, then you can refinance and you can go back to an insurance-backed or cash value-backed line of credit, right? That's how you go back and forth. And if you do that and you leverage it in the right way and you manage your cash value and you manage your line of credit, your policy loan provision properly, you can amplify the returns inside of your policy. And if you then are looking for other opportunities, like whether you're looking to invest in real estate right now, the rates that you're gonna get and pay through your whole life policy loan provision are cheaper than any rate that you're gonna get through a bank right now. That's extremely powerful. You gotta look at the benefit of that. And then if you're in the hard money space, that's a great place, a whole life, utilizing and leveraging your whole life insurance rather than just lending it out in general from cash from a bank account is gonna be extremely powerful. So if you haven't learned about that, I got a really cool video called Infinite Banking Simplified that explains why, if this is kind of like your first, I guess, foray into learning about how to leverage whole life insurance in this way, I've got a cool video that will explain why you would want to leverage your whole life insurance cash value instead of utilizing bank and cash just on its own without having it flow through a whole life insurance policy first. Go check that out. I'll put the link in the card above, and I'll also put the video on the end screen here at the end of the video. So if you have any questions about all this, feel free, chime in, leave a comment in the comment section below. If you're dealing with this yourself and you need help looking at it, go ahead down in the link below. You could schedule a clarity call with somebody on the team. We can help guide you through that as to what makes sense or what may not make sense for you. We can give you a little coaching on that. But yeah, that's it for this video. I just wanted to come on here because I'm getting a lot of questions about this line of credit. Should I use a third-party bank? Should I not? Should I use a policy loan provision? Does it make sense? How does all that work? And at the end of the day, it all changes based on the market environment that we're in. And right now, this is kind of where we are. So hopefully you found value in this. If you did, please like it, share it, get this video out there to people. And until next time, have a blessed, inspirational day. We'll talk soon. See ya.